Welcome back. Major financial institutions such as Goldman Sachs and JPMorgan Chase have recently raised expectations for China's economic growth in 2025, saying the improved outlook for growth, the better prospects for corporate profits, and relatively low valuation of Chinese assets are driving medium and long-term appeal for the Chinese market among global investors. And we'll also take a close look at the economic front in this sector. So Radhika, I will start with you. Do you agree with this generally, more optimistic outlook of the Chinese economic growth?
Well, on the one hand, of course, I agree that the China's economic outlook is very good. What's interesting, though, is that these big financial institutions have only seemed to realize that now, and so what that tells us is, that. And you also mentioned that China's economic assets have generally been undervalued. So what's happening is that in the context of the turmoil that Trump has created, the tariffs and everything else, what's happening is that people are realizing that investing in the United States is now becoming more dangerous for a number of reasons. In the uncertainty that Trump has created is only one aspect, but there is another aspect, which is that investors, including these big investment houses, have realized that American assets are in bubble territory. They are, as one writer put it many months ago now in the Financial Times, they are overbought, overowned, and overhyped. So this realization is now kicking in. So now they're looking for alternatives. And of course, China looks very attractive, not least because in the past, the same investment houses have undervalued Chinese assets. So now they are looking at Chinese assets. Suddenly, Chinese assets look more attractive, more stable, more capable of creating reliable growth. And of course, China's prospects look very good on a number of counts. There is, of course, not the Trumpian uncertainty. And even where Trumpian uncertainty is concerned, China has, over the last many years, over the last decade or so, reduced its exposure to the United States. So China can be expected to weather the tariff storm relatively well. All the negatives that have usually been listed for China, whether it is, there's a property bubble that's, going wrong, etc., the Chinese government has shown that it's able to handle this. And now there is also another element, which is that with the dual circulation policy, what we are seeing is that there is now a very, very, and with the dual circulation policy and the rise in wages that we've seen consistently over the last couple of decades, China is now appearing to be a more and more attractive market. So for all these reasons, I think that the Western investors are realizing that compared to the United States, China is looking very good.
Well, Qian Jun, of course, if you look at the latest release of the numbers, for example, the trade from the Customs Office, of course, in the first 5 months, the trade, import, export of goods, so rose by 2.5% to 2.5 trillion US dollars. Export to ASEAN countries increased more than 10%, believe like 17%. And also to, say, Euro, the EU region also increased. Of course, export to the US, decreased to a large extent because of the tariff war over there. What do you make of these numbers? Of course, trade is an important part of the economy, right?
So the trade data shows that the export-import sectors of China are actually still doing quite well. And as you said, the big change is that the shift, the bilateral U.S.-China trade, obviously, given obvious reasons, has come down quite a bit. Although it's yet to be seen whether the two leadership teams in London, whether they can reach some sort of a longer-term deal. As you said, the big shift is that the bilateral trade between U.S. and China dropped, but China and the ASEAN economies have gone up. In fact, the ASEAN economies have been China's biggest bilateral trading partner since 2020. And this trend will continue. On the other hand, given the uncertainties coming out of the U.S., because the U.S. is not only negotiating with China, but also all the other regions and countries, it's natural that China and the other countries can get together and stabilize trade relations. So again, it's not surprising that China is also increasing the volume of trade between China and the EU. I should also say that although the data looks good for now, but for the entire year, we should not expect export and import to play as important a role in terms of boosting economic growth as last year, because the overall situation has changed a bit. We should rely more on issues like domestic sectors and domestic consumption, and also very importantly, the financial markets are also playing a very positive role, as we just discovered, in attracting foreign capital and domestic capital and boosting these Chinese listed firms.
Okay, Anthony, given what Radhika and Qian Jun has said, obviously we are seeing kind of like a mixed picture. On one hand, we are, let's say, optimism there is in terms of attracting foreign investment in the financial sector. At the same time, we do see, export to the U.S. is one probably minus factor, and also the consumption, CPI, for example, is again falling for the consecutive fourth months. Obviously, domestic consumption is not probably as strong as the government expected. Is not there yet. And what do you make of the overall picture of the Chinese economy?
I think when you look at the overall picture, you got to take into account what Professor Desai and Professor Xingding mentioned, and that is that China is doing its best to stabilize the economy. We saw that retail sales in China going up 5.1% year over year, which is that dual circulation policy in operation. We also saw that China is moving to increase its deficit to GDP ratio to about 4%. So again, making its effort to try to stimulate the economy and not just rely on exports, because as you mentioned, the exports to the United States dropped by 34.5%. That seems like a big number, but as you heard, the exports to the global south and other Asian countries offset that, and that's why the overall exports on a year-over-year basis for China were not that far off from the consensus numbers. And by the way, as you start to see these negotiations taking place and a pause in trade and the resumption of trade, I suspect that in the next month, you will see a rebound in the exports to the United States. So that's certainly going to take place. And then finally, with regard to valuation, as Professor Desai indicated, there is some excitement about Chinese access. One of the things that I follow very closely are the forward price earnings ratio. And the forward price earnings ratio of the S&P 500 in the United States is 21.7. If you look at the China MSCI index, that is around 9.97. So you can see more than a 50% discount relative to U.S. assets. So anyone that wants overseas to diversify their portfolio and pick up assets that are much cheaper than the United States are certainly going to get a little bit more excited about purchasing Chinese equities when the valuations are more than 50% cheaper than they are when you buy U.S. equities.
So Radhika, obviously, as Anthony said, I still remember people are talking about because of some of the policies of President Trump. There's uncertainty in many aspects, and of course, there's major investment banks are thinking of shifting some of the investment to other places. Maybe the China market is offering a choice. Or not only the China, probably European countries, other countries too, for those money, flowing, or they are, looking at, probably leaving the U.S. market, as part of their policy to make sure that it's safe, for safe investment.
Absolutely. I mean, in addition to what my colleagues have just said, Anthony and Professor Chan have said, the interesting fact is that in addition to the point I made, which is that the US market is in bubble territory, it's overvalued massively. On top of that, you also have this strange phenomenon where, on the one hand, the US accounts for some 70% of global stock market, like the stock market value. This is huge, especially if you consider that the underlying productive capacity of the United States is not that strong at all. It's been declining, it's been deindustrializing, etc. That's one thing. The second thing is that within this a huge overvaluation of the American market, the tech stocks, the so-called Magnificent Seven, have been, of course, doing all the running. That is to say, they are the ones that are primarily overvalued. So not only are American assets massively overvalued, within them, bulk of the overvaluation hinges on these Magnificent Seven. And the prospects for these Magnificent Seven are probably not as rosy as most people think, especially given what happened earlier this year vis-a-vis DeepSeek and so on. So I think that, and so their value, of course, has held up. The stock market for these assets declined for a while, then they caught up again. But the fact is there is basically a lot of investors looking for somewhere to go. But now the penny has dropped that the American market is not as safe, is not as secure. So you are right. European stocks are looking good. And in fact, I should add that the story of European stocks looking good to American investors, this has been the story for the last year or so, I would say. Even under Biden, this was the case. Investors were going to Europe because those stocks were also comparatively undervalued in much the way that Anthony was saying. And now, of course, Chinese stocks are looking very good because they have been undervalued in the past. So now, these people are looking for an alternative, and suddenly China is shining a lot.
Professor Qian Jun, of course, on one hand, there's expectation, there's an inflow of investment from overseas. On the other hand, of course, there's expectation, when it comes to like CPI, or still remains, the consumption, which remains weak, and people are expecting probably the central government to do more in terms of a stimulus, especially when it comes to the meeting later this month in Shanghai. So anything more we can expect the government to probably to do to further enhance the domestic consumption?
Sure. So before I comment on consumption, let me add a few more things on the investment in China. So we talked about the Chinese tech companies, including those big tech companies listed in the Hong Kong market, like Tencent, Alibaba, JD, Xiaomi, Meituan, etc. Also, that includes close to 600 tech stocks listed on Shanghai Exchange's Starboard. It's not just they're cheap. They're actually very good, right? So if you look at, the best in finance, the best so-called pairs trading is if you look at Tesla versus BYD. BYD, in a lot of aspects, has done better than Tesla. For example, the total volume of production. Its ROA, the profitability, has caught up. It actually now spends more money in R&D than Tesla. Yet, as of the end of last year, now we know that Tesla has dropped a little bit. As of the end of last year, Tesla's evaluation, if you look at some of these metrics, is still 3 times that of BYD. So certainly international money should look more at Chinese tech sectors. So that's the first thing I want to add. For consumption, I think it's very important at this time to boost Chinese consumption at a broad level. There are 3 preset conditions. Number one, for households in urban areas, their most important assets, their house, their apartment. So which means for the government, for the consumption sector, we need to stabilize the housing market so as to avoid a negative wealth effect on these urban households on consumption. That's condition number one. 2, for those people without a house, without an apartment, income is obviously very important. And for most of them, wages is their most important form of income, which means the government can help consumption by keeping the financial assistance to small and medium enterprises, because these companies provide the largest number of opportunities of employment in cities. And the third one is that the government can also boost social security system, because Chinese households sometimes have this tendency to save. If we do well in those 3 areas, I think consumption will rebound.
So Anthony, if you want to achieve those 3 areas, let's reach a certain goal. It will take time, right? It's not something you can do overnight.
No, it is. It will take time, but I think that the government needs to move in that direction, because if you don't have a stronger safety net, then that savings rate is going to continue to remain high. But I'm going to add another fourth point to that list, and that is that for the government to sort of expand the opportunities for the rural parts of China, for those individuals that are migrant workers to come to the urban areas from the rural areas, and be able to feel more comfortable living there, more opportunities for them to gain houses, more opportunities for them to be able to send their children to the local schools. All those things are going to increase the amount of consumption that takes place as you permit more security and more opportunities for these individuals. So greater urbanization, greater opportunity for that, all those factors to support the rural areas, I think is going to be pretty exciting, because if you look at the savings rate of the people that live in the rural areas in China and the people that live in the urban areas, the savings rate from the rural areas is much higher than the savings rate of the urban areas, where they, believe it or not, on a relative basis, feel a lot more comfortable. So the fact that you move that in that direction is going to be very positive. And finally, I would hope that as the cessation of these trade tensions start to ease, that the central bank does not continue to feel complacent and doesn't slow down its ability to stimulate the economy. As you see, maybe more liquidity injections, more reductions in the reserve requirement ratio, and more reductions in interest rates to stimulate demand, because as you correctly pointed out, consumer prices remain depressed. And you can even see that on the export side. When you look at the export data from China, if you look at export volumes and export volumes versus the export value, you can see that the volumes are greater than the value. So that indicates that even China is exporting some of this deflation. So we need to remove some of that deflationary pressure to stimulate the economy in China.
Well, speak of that, Qian Jun, there's one view, they point a finger at this, fierce competition among the EV producers, like they are fighting for the export by lowering their prices there, and probably in a way that's not really healthy.
I do think that is an issue. EV is one sector. There are some other sectors, new energy, for example, solar panels. And this is potentially a problem for Chinese companies going abroad. Because domestically, so we know that one of the reasons why these EV producers are going abroad is they believe that domestic competition is so fierce that their expected profit margin is not high enough. The problem is when you go abroad and if you carry the same tactics competition-wise in the domestic market, you're not going to go very far in these other regions. So I think it's very important for the government, a different segment of the government, including these agencies to control prices, they need to act. For example, if you see a firm consistently set the price of their product below the cost, you need to correct that, because that cannot sustain. So I think that, and also if prices of these products start to mark up, that's also going to help raising the general price level.
Yes.
And as we talk about getting out of the sort of deflationary pressure.
Right. With that, we come to the end of today's discussion. Many thanks to our guests. You can also watch us on the CGTN app on YouTube. I'm Qian Jun, thanks for being with us. See you next time.